afternoon, Steve Charlton for a midweek update for you. Well, with the start of a brand new month and mid-second quarter, this is traditionally a time when many funds and large institutions allocate capital to the markets. And yet stocks have been quite lackluster. Long-term treasuries sold off aggressively when inflation data came back hotter than expected in the manufacturing sector. And it has created the looming specter of stagflation. So we find ourselves in another precarious position with the market, my friends. The creation of the VIX 1D index, another Fed rate hike of 25 points, one Republic Bank going under, the second biggest bank failure next to Washington Mutual, every major bank out there shouting recession and expecting a 20 to 35% loss in the markets over the next 12 months. Even with all of this noise, all of this turmoil, the deeper rooted and truly more dangerous reality is that we are now looking at a real possibility of a global financial crisis. When will we see the next global financial crisis? This is the headlines across the planet. And the issue is that crises aren't your traditional recessions. They add extreme stress, not just to asset prices, but also the whole financial system. When they do happen, markets stop functioning properly, they result in fear triggers and some of the sharpest losses. And then more cracks continuing to appear in many parts of the system. People right now are just wondering, are we already heading that way or are we already in it? Most that I speak with believe there's a lot more volatility and losses to come. One question to ask is, what can cause the next financial crisis? You see, they're never created by a single factor. Sure, they often start with small problems in the dark recesses of the market, kind of like the subprime mortgages in 2008. But it takes the bursting of a serious bubble, like the housing market in 2008, and then the presence of several reinforcing factors like high leverage, hidden risks in financial products, deep links between different parties. You see, you need many factors for the world's financial system to begin to bubble. So this next crisis most likely will not be driven by the same factors. However, real estate still probably will have a role in it again, but there will probably be new forces at work. Some examples may be private markets. Markets like real estate, venture capital, private debt, and private equity have seen the largest increase over recent years. They provide a very fertile hunting ground for where things could go wrong, as many of these vehicles are illiquid, highly leveraged, complex, and opaque, and they prove particularly fragile, especially if volatility continues to rise and investors are forced to sell. Next, we look at asset managers. Let's face it, really since the 2009 crisis, they basically have replaced banks as the end-all be-all, and they have all started to begin to venture out into even more complex strategies and products. Remember mortgage-backed securities? And it's not just the hedge funds. The biggest asset managers have launched loads of ETFs, some exotic, some highly leveraged, illiquid, many with the same investment rules. This could create issues if investors all run for the exits at one time. Even as the IMF recently warned, even safe instruments like open-ended bond funds, which hold a fifth of all financial assets held outside of banks, could pose a significant threat to market stability. Then we have the fixed income markets. Debt markets could be a big trouble spot again, but probably in a new way, perhaps arising from the shattering of some complex interest rates and derivative products, or from a total collapse of the liquidity in the bond market as a whole. Or more likely, to sharply rising dollar could eventually lead way to sovereign defaults. How about self-reinforcing factors? Remember in the aftermath of the 2008-09 global financial crisis? Tons of new regulations were added and adopted just to try to curb the reinforcing factors that exacerbated the system's fall in the first place. But plenty still exist. For example, banks' riskiest activities are now performed by other intermediaries like hedge funds, which may mean that the systemic risk has simply moved to other areas. And with banks no longer performing the role of traditional intermediaries, that's made market liquidity, which is the ability to quickly purchase an asset, a lot more difficult and unpredictable. And then derivatives, despite being restricted, still present significant risk. It's still hard to know what's on the other side of those trades in the first place. And finally, many professionals still have a mismatch between their assets and their liabilities, like borrowing in the short term and then lending for the long term, or borrowing from a safe asset to buy a risky, or maybe borrowing in another currency. Those mismatches tend to lead to forced selling when market conditions worsen, as the recent failure of the liability-driven investment strategies have illustrated to us. Then, of course, other potential risks to point out: clearinghouses. This is the place where financial institutions complete transactions. They could fail. Cyber attacks could happen. Timing when a bubble bursts isn't the only hard part. Knowing when things actually go from the downturn into a full-blown financial crisis is the other. Take the last one. The first signs of trouble started to appear in early 2007. But it was only in 2008 that investors really started to take notice and worry that issues with the housing market would spread to the economy and the financial system as a whole. And while it took months for the S&P 500 to lose the first 25%, it took less than 2 weeks for it to fall another 20%. Prices then recovered 20% before collapsing another 25% and didn't find the bottom until March of 2009. These are called bear market bounces. To 07 to 09, there were 6 bear market bounces, averaged about 16% of raises, and we still lost 62% of our money. Even then, investors still did not know whether the recovery had truly yet begun. The bubble of highly speculative assets, it's already popped. Stocks are already in a bear market, a strong dollar, liquidity issue in treasury markets, stress in the United Kingdom financial system, sky-high costs of protecting against defaults of European banks. These are all still adding to market troubles. So it is fair to say that if a financial crisis is indeed on the way, it could arrive sooner rather than later. But here's the first hard truth. No one knows what's going to spark the next financial crisis. The same way that no one expected the pension funds could be so close to blowing up in this UK financial system last week. No one really knows which market or products could start a global chain reaction either. If we knew, the crisis probably could be averted. The second hard truth is no one knows exactly when the next financial crisis will hit. Oh yes, we can guess and speculate, but almost certainly it'll take us surprise and hit us like a thief in the night. Financial crises are not subtle things. When the next one arrives, prices probably will move so fast that it'll be extremely difficult to make any money from it. The third truth, we've got no clue how bad this next financial crisis is going to be. So what do you do? Well, first of all, you should start by accepting the facts that things we don't know significantly outnumber the things that we do know right now when it comes to the next financial crisis. But even if we don't know what will cause it, when it will hit, or how bad it will be, we do know that stubbornly high inflation and a strong labor market are forcing the hand of the Federal Reserve to raise interest rates at its fastest pace ever. And those cracks have appeared en masse in the global financial system. This doesn't mean that a financial crisis is a certainty, but it significantly raises the probability of something going very wrong. Put more simply, it means that you can hope for the best, but you really should prepare for the worst. But give yourself the ability to safely pivot on a dime. Is your portfolio set up to do just that? And you have to be able to focus on what you control and make sure your portfolio can survive what you cannot control. That means avoiding using leverage and making sure that you can psychologically and financially handle large losses and extreme uncertainty. If you don't think that you can handle a loss larger than 50%, you have to reduce your risk. It is as simple as that, now more than ever. Make sure that if you have money in market accounts, that is money that you can afford to lose. If you cannot afford to lose it, you need to get out of those positions. Does that mean you take all of your money out of securities? Heavens no. But if you can't lose it, what else are you going to do? And certainly it's a great idea to have cash on hand for when the opportunities arise, because behind every big fall, most certainly is an opportunity. But you have to devise a clear game plan for when and what you'll start buying it. If you're not sure how to do this, schedule a time on our calendar below and we'd be more than glad to have a conversation with you and see how we can come alongside each other with expert advice and wise guidance. Finally, remember that absolutely no one can forecast exactly what will happen next. So take everything you read, watch, and listen with a grain of salt. Don't let fear of missing out or panic drive your decisions. Investing is often won with your guts and not with your brain. Now, that being said, if you want to know for certain and gain a specific peace of mind, then yes, the mathematics are certainly what you're going to want and need to use and focus on. But here's the reality. Speculative bubbles have popped. Cracks are again beginning to appear in the global financial system. That all raises the chance that we will experience a financial crisis globally. So being prepared in advance is always going to give you the best probability of success and winning. Folks, I wish you have a happy Very Wednesday. Until we speak one-on-one or on another market insight, thank you so much again for tuning in. Have a great rest of your week. Thank you and God bless.